This is Bloomberg on the Money. I'm Charlie Stein. Joining us from our studio in New York is Keenan, president of Samex Capital Partners. Keenan, thanks for joining us today.
Well, Charlie, thank you for the invite, and I look forward to talking with you.
Keenan, you were one of the first people, I would say, we spoke to here, and I don't even remember how long ago. It was pretty gloomy about the economy and the stock market, going back a good long way. When did you turn bearish, and what were you looking at that put you in that direction?
Well, we got all of our retirement clients, 401ks, and IRA clients completely 100% out of the stock market by September 26, 2007. We had a series of new highs in the S&P in June, in July, and again in October. And each new high, which was a higher level, was followed by lower levels in a lot of indicators, percentages of stocks hitting new highs, percentages of stocks above certain moving averages, and on and on. This is a lot of technical data, but needless to say, the market kept going higher. The internal condition of the market did not follow during, again, the June, July, and by October. So by the middle of October, we were really raising the red flags as powerfully as we could.
So those indicators, without getting too specific about them, they tell you that we're kind of in the last gasp of a bull market?
Right, exactly. You can watch, because what happens is a bull market needs fuel, it needs power, it needs participation. And in the beginning stages of a bull market, everything goes up. And as it goes on, let's say it's going to last for 4 years. By the 3.5-year mark, you'll begin to see, without a doubt, there's a lot less participation. Doesn't mean the market can't go higher, but there are fewer stocks that are taking the market higher. And over time, that simply cannot persist. That is an unsustainable environment. It's hard to tell exactly how long it's going to last. But I can tell you with a certainty it is an unsustainable environment. We saw the same thing leading up to 2000, and again right here the last bull market top last October.
When you moved out of the market there in September 2007, what did your clients say to you?
They were certainly skeptical at the time, the ones that hadn't been with us. Some select group of our clients have been with us from 2000 and recognized that we got them out right at the top of the market in 2000 as well. And this time around, those people were not asking a lot of questions. What the questions started to come, though, Charlie, is by December and January and March and May, and as the 2008 calendar wore on, and we kept out of the market. And by the spring of last year, a lot of clients were calling and asking, as an example, into the March low, why are we still out of the market? And the market goes higher in late March and keeps going higher all of April and keeps going higher for the first 3 weeks of May. That's when we started to get a lot of questions. And we had to really hold our ground and educate them and help them understand that even though the market was going higher, the internal condition was not improving at all. I mean, from the March low to the May high, which was the last big rally, the market looked terrible. There was no volume. There was no broadening out of the participation. It was just the Dow and the S&P in a normal bear market rally. But then in the last couple of weeks, the questions have come to a complete stop.
So the fact that people are asking, does that mean you're turning bullish?
No, I think they finally understand, though, that we got them out for a reason. And when they saw the absolute bloodletting that has gone on recently, their eyes became very clear.
Let's take a quick check of the stock market here. The Dow Jones Industrial Average up 1 3/4%, 143 points to 8,315. The S&P up 1.5, 12 points to 860. The Nasdaq up 9/10, 14 points to 1520. Oil is at 63.21. It's little change today. Gold's at 7.39. It's down $3. And the 10-year Treasury note right now yields 3.82%. It's down 1 3/30 in price. This portion of Bloomberg on the Money is brought to you by First Republic Bank. We're speaking with Keenan. He's president of Samex Capital Partners. He's in our studio in New York. So, Keenan, you've not seen anything yet that tells you it's time to jump back in?
No, actually, we see a lot of evidence that points to some lower prices, but it may not be immediately. It doesn't have to be tomorrow. Remember that bear markets often have rallies that are very powerful and quite convincing. From 29 until 1932, during the Dow's drop of 88% from high to low, there were 7 cases where the Dow rallied 20% or more. 7 cases. And I'm sure all of them, the rallies of the period, were convincing a lot of people, hey, the bear market's over. And yet, within a few weeks or a few months, the market was setting new lows. In 2001 and in 2002, there were a total of 4 rallies that took the market up 20% or more. 3 of the 4, 24%. And again, they should have been pretty convincing. So we think we're overdue for a rally at any point, starting maybe yesterday, today, at any point, where the markets can go up for more than a day or two, a few weeks, perhaps even a few months. But I feel strongly...
Do you play those rallies, or do you stay on the sidelines?
We will look at the rallies because the market is so devastated on the downside right now that we think we could see some upside that will last, again, a few weeks to a few months. But we do it with smaller amounts of capital. We do it with broad-based indexes, conservative-style stocks, because if the Dow rallies 30% in a 2-month period of time, and it's a dangerous rally, we only would look to take a small portion of that off. We think 7,900 in the Dow is not the ultimate low of this bear market.
When you get gloomy, as you did last September, do you simply sit in cash and bonds and wait, or do you actually bet against the market?
We have two different businesses, Charlie. One is a registered investment advisor where the 401k clients are. We go to cash and we wait. And again, we've been there 13 months and we're still waiting. We also have a hedge fund company, and we've been shorting the market for the past 13 months, and that has proven to be rather successful.
And when you short, do you use ETFs?
Yes, we do. We use ETFs against the broad market indexes like the Dow, the S&P, the 4Qs. We also, it hasn't been recent, but we've also been short the broker-dealer index, which is letter IAI, the financials XLF. There have been several different ETFs that we've shorted in the past 12 months that have rung up some pretty good profits for us.
I noticed it in the notes you sent along to us. You talked about inflation as a long-term issue. Clearly, it doesn't seem to be an issue right now. What makes you think it will be?
Well, first of all, we are still in that deflationary period of the bear market where if you buy goods or services with anyone you're dealing with, you're probably going to be well served by asking them to give you a lower price than what they first quote, and they perhaps will even give it to you. So you see that across the board, not just here, but all over the world as well. But that won't continue. The reason is the amount of money that the federal government has both borrowed and is going to print in the near future to get us out of these things that we've gotten ourselves into is going to be unprecedented on any historical level.
Is that what we're seeing even today on a day when the long end of the bond market is way, way off, even although there's not really any good economic news?
I mean, Charlie, I really do believe that. I think we're seeing the early specters, but it's very, very early because the markets are still going to be under pressure. We're still going to see that deflationary period like we just talked about. But over time, you go out a little bit. Let's say the market bottoms in, March, and 7,000 is the number, just for illustration. I think within 6 months of that, the 10-year is going to begin a rapid ascent to the upside. Oil will make another assault to $200 a barrel, perhaps. Not saying it's going to go there, but it'll start to work its way higher. And I think we see inflationary problems, the likes of which haven't been seen since the late 1970s. I think it's going to be that strong, that dangerous, and people need to be leery of it in a very, very powerful way.
30 seconds here, and then we'll continue. It doesn't sound like good news for the stock market, does it?
Well, right. Typically, bull markets last 4 years and the Dow doubles. The next bull market maybe only lasts 3 years and the Dow perhaps only goes up 60 or 65% because that inflation specter is going to start to come back. And again, it's going to have a very strong hand.
20 seconds. So we're talking here 3 to 5 years out?
Right, exactly. So people have to watch. And the 10-year, by the way, Charlie, that's the tell. Watch the 10-year. It got up above 4 only a week and a half ago. It came right back down as the stock market got hit. As it starts to break 4.5 and 5, keep a close eye on that.